Hey guys, today I want to talk about an advanced trading strategy that many of you probably aren't familiar with, even if you know about options trading, and that's called a calendar spread. Now it's important to note, and I say this solely for legal reasons, but nothing that we're going to talk about here today should be construed as investment advice. Everything here is solely for entertainment and for education purposes. I'm not recommending that you do any specific trade of any sort with any individual stock. Make sure you're aware of this. Okay, so what we've got here are two different sets of call and put options for the same stock for two different time periods. Up top, we've got June 2020 options expiring June 19th, and then down below, we've got the options expiring January 15th, 2021, right? Same set of strike prices that you see. On the left, we have calls. On the right, we have puts, all right? And we see this is a fairly actively traded set of options. This happens to be for Boeing, but we could do this for any stock that's out there, right? So June up top, expiring in just over 6 weeks or so from the date that we pulled these prices to January at the bottom, so about 8 months or so. All right, now, what kind of strategy could we pursue here? Well, there's a lot of different options, but what I'm interested in talking about is what's called a calendar spread. This is going to capitalize on the difference between these options prices at two different points in time. Now, we're looking at exactly the same option, the $130 calls in June versus January. Now, what you're going to see here, if we just use the last price that's traded, because this trades every day, it's a pretty active contract. The Junes, we're going for about $15.30. The Januaries go for $31.76. But notice, that strike price is the same. So you actually don't have any price risk, right? Either way, if we kind of fast forward in time, if Boeing were trading here at $200 a share at the end of this time period, each of these things would be worth $70 at expiration. If it were trading at $100 a share, each of them would be worth $0 at expiration. So the only difference here is the amount of time that's left on that options contract. Now, what you want to target with a calendar spread is a strike price that should be close to the stock price, and you're looking also for a stock that won't fluctuate much, where you expect it might kind of stay in a trading range over time. More to come on that. So, what could we do here? Well, if we buy the January 130s, then our cost is $31.76, all right? That's $31.76 per share. Now, we can turn around and we can sell those June 130s for $15.30 per share. And just to keep the math simple, I'm going to stick with just the per share price throughout the rest of this talk. So we're buying those Januaries at $31.76. We're selling the Junes for $15.30. So up front, we have a little bit of a cost, right? About $16.46 here, if my math is right. But when those Junes expire in 6 weeks, if they expire at, say, $110, $120, $130, they have no value, right? But that January still has some value left. We could turn around in June when these things expire and then sell the Julys, and then the Augusts, and then the September, and we can keep going like that. So ultimately, at the end of the day, we get to sell 8 months worth of options for the price of buying 1 month of options. That's a pretty good deal, right? Now, the math isn't exact, of course, because we're about 6 weeks out versus each of these options would be about 4 weeks out. But the idea is that we might make as much as $90.64 per share, because we get to sell 8 of these options at, say, $15.30 a piece, just to kind of make the math easy, minus we paid $31.76 up front. So that would give us a total profit of $90.64 per share, 300% gain. Even if we figured that we could only sell these things going forward for, say, $10 per share, right, because there's a shorter time frame, well, we get to sell the first one for $15.30, plus the next 7 for $10. That's $85 per share. minus, again, 31.76 means about $50 in profit, 150% gain. So there's a significant upside to this kind of calendar spread if you do it right. Now, why does this work? Well, the answer is all about the time value, what we sometimes refer to as theta value in stocks, right? Or in options, I should say. So as an option gets closer to expiration, that time value, the theta, falls faster. Essentially, you're selling very expensive time and protecting yourself with cheap time, right? And this kind of makes sense if you think about it from a human perspective, right? In the last few years of somebody's life, they don't have very much time left, so you're going to focus all your time on doing stuff that's really important. As you get close to the end of your life, you're spending all your time with friends and family, stuff like that. Early on, you can do all kinds of goofy stuff. This is why we send people off to college, in some sense, when they're young, not when they're 90 years old, right? Not too many people who are 90 go off to college, even though they could probably afford it well. Anyway, dumb example, but you get the point, right? As the option gets close to expiration, it's got very little time left for that stock to spike. And so as a result, every single day counts. If that option's only got 2 days left to expiration, if something big doesn't happen, man, that thing's going to expire worthless. In contrast, if it's got 8 months to expiration, if nothing happens in the next 2 days, no big deal. So you're selling expensive time, protecting yourself with cheap time. That's the idea. Now, what could go wrong? Well, the answer is, with a calendar spread, what you're really looking for is a stock that's going to stay in a narrow trading range, or where you believe it's going to stay in a narrow trading range. If that stock moves a lot, your trade can go bad. So if the stock price goes up $100 by June, those $130 calls, they're going to be worth about $100 right before expiration, because we're selling a stock that's approximately at the money, right? It's trading right around $130. So if it goes up to $230, hey, at expiration, it's going to be worth about $100. Now your Januaries will be worth more. They might be worth, say, $105, right? Because they've still got some time value in there, but it's not going to be enough to prevent a loss. So in this case, as an example, this trade, right, you've paid $31.76 on those Januaries. You received $15.30 for selling the Junes. Now, when you go to trade those Junes in, you have to pay $100 to kind of close out that trade, and you could turn around and sell your Januaries for $105. That would give you a loss of $11.46 per share. So it's a loss. It's not a real bad loss, but of course we never want to see any loss at all. So that's the risk here in a calendar spread trade. So the key, look for stocks that you don't expect to move that much, but which have a pretty nice profit potential when we compare between like a 1 month out contract versus a 6 month out or a 1 year out contract. That's the key. You're betting on that volatility being relatively low. If volatility is going to explode, you're going to be in trouble. So you want to avoid having real volatile stocks, and at the same time, everything else you're doing is just betting on a basic underlying core principle of options. Theta decay. That cheap that cheap time on a long-term option versus the expensive time on a short-term option. It's a real good trade. I've made a lot of money doing this over the years. It's very, very interesting as an opportunity. You'll have to find specific options. You have to hunt around to make this work, but it can be a very, very good option depending on your strategy and your particular needs. Of course, it's not right for everybody, so you want to be careful about whether this is a good fit for your investments.